Deepak Shenoy, is the nightmare over, or the nightmare will come back again? I mean, for long-term investors, how should we look at last 3 months?
I think, it's an interesting thing that we call it a nightmare, because I think it's been tough for people who perhaps haven't seen steep falls in the index. But I think it's overall, if you're like you've seen 2008, you've seen 2013. I think you're apart from the 2020, I'm talking about steeper falls. I think those times were tougher than this, way tougher. And while I would say this is a bad dream, those things would be nightmares. I think, yeah, I mean, we're down. We went down to 10%. We came back up. The GDP numbers are problematic, but I think part of it had to do with the relatively slow recovery from the post-election result phase, when you didn't get as many capex orders. The budget was end of July, so there wasn't that much from the government expenditure moving, though government expenditure did propel some of this space. And the manufacturing numbers were relatively low. Again, I think this is because of close down of some of the government orders at that time. Since then, we are seeing a bit of a recovery. I think markets will, kind of price in some of these things in terms of a recovery, which is why the market has probably gone up. I'm very surprised that the market has gone up today, despite the dollar rising more. Despite perhaps even the manufacturing companies, you're seeing pretty sharp increases in prices. So I think maybe the market knows a little more, but it seems incongruent to the economic data. And inflation numbers actually in the September quarter seem to be much lower in the government GDP accounts than it seems to be on the CPI. So there is a bit of a dichotomy there as well.
All right, Kunal, is today's price action impressive, or today's price action is something which actually raises more question mark about ability of the market to hold on?
No, I think it's neither of the two, because it's it's something which I have probably anticipated in the morning, that we may not see a very rare kind of a day for the indices. We may just about see the index getting into a range. I think except for the last half an hour, where there's been some pickup of price action for the Bank Nifty, largely the session for the index today is more on the market breadth. And right from the start, the market breadth was 2:1 for the index, for the overall markets, and it's maintained that kind of a market breadth. So I think that's the more comfortable and a positive sign for the index, which means that what we are looking out for over the next maybe few days or over the next 1 or 2 weeks is a broader bit of consolidation for the indices coming out. So we're settling into ranges for many indicators. For example, the India VIX, which was at 17 and a half odd levels, we're settling into a range where the India VIX is settling around the 14.5 to 15 odd mark, and that's a positive sign. So till the time we see lowering of ranges for India VIX, there could be a possibility that the index may keep on giving you those mild breakouts for itself. You have 24,000, 24,500 as now the strong hubs, where there's been put writing as well as call writing respectively for the indices, which means we are looking at a midpoint range of 24,250 as a pivot for the Nifty, and even for the Bank Nifty, some bit of strength coming back again around the 52,000 mark. So I think on the back of this, the overall market breadth and slight improvement of indicators across the board, I would believe that we should consolidate further.
Consolidate further, but just taking stock of some of the stock specific moves today. So Dixon Tech is in focus. Of course, that mass production of Google Pixel smartphones is something that has got the street excited. So that stock has been holding up since the start of the day, 5% higher. Ola Electric has seen quite a bit of bounce back from the lows of the trading session. When we started, it was down about 2 to 3%. Now it's in the green by around 7%. The company has come out with the plan to accelerate the distribution network, a fourfold expansion of the company-owned store to 4,000 by December 2024. That was the latest tweet that came in from Bhavish Agarwal, and that's the reason that stock is on fire right now. And then cement stocks are building on to gains. Ultratech Cement, JK Cement, Shree Cement. Jeffrey says that cement prices are likely to go up by 10 to 15 rupees per bag in December, and they're calling out the bottom of the pricing of the cement pack, and that's the reason all of these names are excited. You also have a Torrent Power in focus, because reports and agencies are now reporting that perhaps a QIP is imminent on that one. There has been some news flow around that already, but now we understand that it can happen as soon as this week itself. There's a bit of a traction on IRB infrastructure. Affle India is seeing quite a bit of traction at the moment. Happiest Minds is up 7%. So across the board, good amount of traction coming in. But Ola Electric is what I want to discuss with you further, Deepak. What's the take? I mean, people who have so-called burned their hands with bad servicing, that, kind of becomes a problem area for the company. But they're doing a lot, whether it's expanding the distribution network or coming out with now new products which are a lot more attractively priced, maybe for the gig workers, etc. Would you now look at buying afresh in Ola?
It's interesting, but I'll tell you two things that are happening here. One is there is a customer's disservice set of complaints that seem to be coming across. And I mean, I hope the company is handling it in a better way. Hopefully it will move in. But when you have an expansion from 600 to 4,000 or, the numbers that have been put out, this is usually, this is a feat of execution that kind of talks about, but typically something that moves as fast as this will have a lot of initial problems. And when you have a scale of 600 to 4,000, the magnification of those problems is even huger. So if you're facing customer service complaints already, I can imagine that this will only go up in the future. So I think while people are very, gung-ho about the number of stores opening up and perhaps more business that will start moving because of the newer products they're starting to launch, my feeling is that some part of this will also get overweighed by potential, the problems in growing too fast will probably appear in 2 or 3 months down the line once the operations start to actually get underway. So I would just be wary. Plus, another big problem is that Ola Electric is not yet finished 6 months after listing, and a lot of companies in this space, at least the startup companies, they tend to have a lot of these VC type investors who may not necessarily be able to be part of the company after their lock-in periods are over, which is after 6 months after the list. So I believe that might put some downward pressure on the stock. You'll see this happening even now. Stocks are moving 5%, 4% down, and then 5% up. So there's a lot of volatility. I'd rather wait for this whole thing to settle down before I, take a call on whether we should participate. I think we like the space. The electric vehicle space itself is very exciting. The fact that they have products at a relatively affordable price is exciting. I'm just not sure so much about the investment thesis here. So perhaps great as a consumer if they get their service act together. But as an investor, I'll just still wait and watch.
Is it like buying Zomato at 50 rupees? Is it like buying Policy Bazaar at 400 rupees? Deepak, nobody believed the value of those franchises, but when they came back, they surprised everybody. Could the decline in Ola, for those who bought this in winter of 2024, will they be rewarded by next summer?
No, I hope they will. I don't think there's a reason for me to say they will not. So I think the problem really is whether market expectations and deliveries are two different things. Sometimes, of course, some of the plans are so audacious and big that if they actually prove right, you could see this company valued at a much higher price. But I feel in the near term, you're going to have more trouble than you are going to have. You're going to have the upsides. So the accolades may come only much later. So I'd rather wait till some of these things actually show some kind of result. I know that it's tougher, I mean, to run a company than to perhaps comment on it. So for them to actually bring this execution to a point where it excites investors even on the numbers front rather than just the announcements front, that I think will take some time. So as an investor, I prefer to get in at a point when some of this is visible. I may get in at a much higher price. That's fine with me. I don't have to catch the bottom because you don't know where the bottom is. It sometimes can be much lower from here. We don't know whether this is the exact point at which rock bottom has been hit. And I prefer to see when the numbers react. So a little bit more upside momentum would work for me, both on the price and on the business front.
Since we are talking about some of these latest IPOs, Deepak, let me pick your brains regarding Swiggy as well. The stock actually, post its listing was a bit quiet, but from there it's picked up quite a bit. It's now closer to $500 a piece. It comes out with its Q2 earnings tomorrow. Wouldn't ask you as to what your expectations of earnings are, but overall the thesis on the company, would you recommend staying with the so-called leader of the pack, which is Zomato at the moment, or do you still see value as far as Swiggy is concerned?
So Swiggy is cheaper, Anisha. I think that way you're clearly getting a much lower cost, a lower price company in terms of multiples of in whichever way you kind of analyze the company. But there will be some issues. For instance, Swiggy will have a lot of the overhang that Zomato has probably already passed through, which is the stock option based compensation, non-cash losses that will be visible on the balance sheet because some options have been granted to the top shareholders of Swiggy or top management of Swiggy, which I think will cause some kind of negative on the numbers, at least the headline numbers for a while. So that will be a negative for a short time. Again, the same problem of Swiggy investors wanting to exit, employees wanting to cash in their holdings. That will also play a role in what the stock does after 6 months. The numbers will probably look good because they've been able to increase their take rates both as platform fees and from restaurants as well, reduce discounts somewhat. They've been able to keep order counts relatively high. I will have to see based on how the results come tomorrow, how they're able to shape up. But I think what will be interesting is to see how big Instamart plays in their overall operations. It's given that it's kind of like the third largest player in the segment after Zomato's Blinkit and Zepto. We'll have to see how they are planning to shape up that offering. I think it's a very interesting play. And I also think here that you want to give this company at least 2 quarters of announcing results. Although they've you probably have used them as a customer, we haven't seen them as much as an investor. So after you see 2 quarters, the 6 month holding period will also be over. You'll be able to appreciate how much liquidity is in the stock and how much more news comes around. I think that's when you want to kind of make longer term bets on the stock. I'm more concerned that we're actually operating blind right now in terms of numbers. Recently, we just have the IPO numbers to go with. Let's see what comes out of tomorrow. I think the headline numbers will be more negative because of the non-cash impact of options.
Okay, point taken. That's the view coming in on Swiggy. Let's quickly mark some of those heavyweights as to what they are up to because HDFC Bank was underperforming at the start of the day. Is it now at least batting a bit for the Bulls? That's something to watch out for. And then the other heavyweight, of course, is Reliance. What is that one up to today? The bulk of the heavy lifting is actually being done by Infosys and then Ultratech Cement, which is up 4%. But L&T, HUL, Cipla, these are in the red right.
In conversation with Deepak Shenoy, Kunal Bothra, and then Soni Patnaik. Soni, what do you make of the market recovery? We closed on Friday off from the day's high. Looks like today we are all set to close at the day's high. So do you think now levels like 25,000 are in sight?
Hi, good afternoon, Nikunj. Thank you for having me on the show. So I think Nifty is just about the resistance corner of 24,300 to 24,350. That range is a very strong resistance zone. If it crosses, we can see it heading towards 24,500. But on a positional basis, if these two resistance levels are taken out, then Nifty can test and head towards the 25,000 mark, which would be on account of a very strong short covering. So I think one can hold longs if they are already holding, from the December series of the first day itself. So 24,000 makes a very strong support. So I think 24,000 with that support and base, one can hold on to the longs and there could be a positional target. But, after maybe 1 day or two of a consolidation sideways trend, it can head higher towards 24,800 to 25,000 levels.
That's the take as far as Nifty is concerned, and HDFC Bank is one of that clear leader that Kunal has been talking about as well, and Nikunj has been talking about that 2,000 par on HDFC Bank. Looks like it's likely to come sooner rather than later. But what about cement as a pack, Deepak? Because and I know it's not the first time that we've heard of this. I've been hearing it for the last 6 months, but there's that talk about light at the end of the tunnel and pricing bottoming out. Would you buy that argument finally just because it's something which is so cheap right now?
None of it is. In fact, I think we're seeing very high valuation numbers in some of the stocks. Of course, some of the South Indian stock cement majors are also kind of increasing in price. Though they didn't fall quite as much. We're seeing all-time highs in a few cement stocks as well. I think overall, the September quarter would have anyway been bad because of rains. So you looking at generally there'll be a lull in construction during the rainy season. Cement sales don't happen to be that much this time. This season should have seen a reasonable recovery, and I feel that you know uh, I don't think meaningfully demand is so high that you're going to be able to increase prices meaningfully. But there is a cartel that operates in cement all over the country. So to that extent, if they decide that prices will be raised, then prices will go up. So I think stock prices typically tend to lead some of the early business indicators here, largely because there is, some layer of cartelization of cement prices per se. So I would say, I don't have any investments in cements in our fundamental portfolios, but it appears from price action that it's possible that the fundamentals start looking to get better if they're able to increase prices. I don't know about light at the end of the tunnel, because typically as you increase prices, if you find demand drops off, you will be very quick to drop prices or increase discounts as well. So it will only be time that will tell that. I think temporarily, at least, nothing seems to be wrong or going wrong meaningfully for cement companies. So I think if the economy recovers, they will recover just alongside. Don't see anything special on a trigger there, to be honest.
Bank, Reliance Industries. Now, when these two horsemen they start moving in the same direction, then you can be reasonably assured that markets are in a good shape. These are the underperformers which are now coming back. And every time I say Reliance, Deepak feels happy. Now let me say LIC, which will not make you feel happy.
Yeah, it's LIC has been right there. It's I think the news recently has helped it about the fact that both the finance minister have mentioned banks mis-selling of insurance, and also IRD expressing concerns that some insurance companies derive most of their insurance proceeds primarily from companies that are banking companies that they are involved with. So an SBI Life would have an SBI, and so on. So the bank assurance platform forms a significant portion of their incoming premium. And I think if they wanted to restrict that or tell companies to reduce that influence, then they would have to set up a workforce by themselves, which is something they're not used to do. Independent agents are not quite as big in these companies as it is in LIC. LIC stands to benefit in that way. Recently, of course, benefits from an LIC perspective have been that they've increased market share marginally. They have been able to get good premium growth, 20% plus in certain cases, and they have been able to move up the needle from a 3 or 4%, no, less than 10% at the time of IPO that they've had of non-participating policies, to up to nearly 25% now, which is what they had promised. This year, the last quarter is going to be much better, I think, because they will be able to charge a slightly higher amount of the profits. They started off with 5% of the profits of participating policies that shareholders could get. That will increase to 10% over a period. I think now it's at 7.5. So going forward, I think the last quarter of this company for this financial year and the next financial year should reflect a higher take rate from the shareholder policies. The problematic element for me is that it's a discretionary element when they decide how much profit should be left in the policyholder's account for appropriation later versus how much is actually taken into a quarter in to the shareholders account. This time they have increased their solvency ratios nearly 2 times, which is quite high, and therefore a lot of the profits, extra profits, are remaining in the policyholders account. They've not been transitioned to shareholders at all. I think that is where the discretionary element poses a problem to me, because otherwise this company should be a 40, 45,000 or even 50,000 crore per year PAT number easily. Given take out that risk, and I think the company should be a fairly decent dividend paying company going forward.
Let's see which way it goes. But before I kind of take it across to Anurag to get more details on what's brewing in the entire policy side of insurance, Kunal, quickly wanted to come to you regarding Dixon Tech. That stock has hit the market capitalization of 1 lakh crore for the first time, and it's charging ahead right now. And Affle India is the other one. What's the verdict on Dixon hitting that 1 lakh crore market capitalization and Affle India?
Yeah, so I think Dixon is looking very attractive even at current levels. The stock in the last 2 weeks had gone through a very classical kind of a breakout. So an initial breakout level of 14,750, then a move towards 15,500 mark for Dixon Tech, followed by a couple of days of consolidation. And now the stock has confirmed a breakout even above those 15,500, 15,700 mark, which means that over the last few weeks, we've seen the base or the supports rising up by a margin of 1,000, 1,200 points for Dixon Tech from 14,750 to now 15,750 odd mark. So keeping that as maybe a stop loss or a support point, traders could look at a buy even at current levels. Affle, on the other hand, today is a classical sign of a breakout. It's a triangular pattern breakout for Affle, and it's almost like a 200 to 220 pointer pattern for Affle. So I think closer to 1,500. 1480, 1520 thereabouts is the support for the stock, and 1700 thereabouts is the breakout of this triangular pattern. So and today's volume is apparently one of the higher days for the stock in the last 2 to 3 weeks of the price wise consolidation. So on the back of this, we could expect maybe another 100 points up move for Affle over the very near term.
At record high for Affle, Dixon, Keynes, CAMS, Suvin Pharma. All of these stocks, including KEC and Divi's Lab, are all sitting at all-time high levels. So despite the so-called weakness in pockets, there are certain of these companies which are at record high levels. But just coming back to insurance and taking it across to Anurag, because there are a lot of policy changes which are underway in the sector. What's been the latest one? Let me take it across to Anurag to find out more.
So for the Insurance Act amendment, government is proposing for removal of restrictions for agents to work with multiple insurers. Presently, the rules allow that agent can work with only one life insurance company, one general insurance company, and one standalone health insurance company. But the government has proposed to remove these restrictions, and in the draft bill, government has proposed that multiple agents can work with multiple insurance companies. To have the innovation in the insurance industry and to give the flexibility to the agents to work with multiple insurance companies. So if we talk about the share of a business through individual agent for the listed companies, then LIC get around 95% of their business through agents. For SDFC Life, 18% of their APE is through agent. For ICICI Pru, around 30% of their new business is through individual agents, and for SBI Life, it's around 25%. So agents play an important role for insurance companies for their premium collection, for their new business, and now government is proposing to give them flexibility that an agent can tie up with multiple insurance companies.
Anurag for that, but time now to take the closing trade ideas. Soni, you go first.
So my first idea would be in Jubilant Foods. Now the stock has been consolidating in a range, and here's preempting that if it crosses the 660 mark, you can see it heading higher towards 685 to 700 range. So one can buy Jubilant Food in futures and keep a stop loss of 642. Look for higher targets of 680, 85, and the second higher target would be around 700. The second pick would be in Apollo Hospital, which has seen a fresh breakout today on intraday charts, and it has also crossed its short-term moving averages. And it's also option chain breakout in Apollo Hospital can be seen. So one can buy Apollo Hospital around 70.60, and on small declines up to 17.40, keep a stop loss of 7,000 from current levels, and a target of 7,200 to 7,250 can be seen.
Okay, Kunal, your recommendations?
That will ban Piramal Enterprises after a pause of the last 3 days where the stock had been correcting. It's come back again into a mild breakout mode, yet to break out of the previous swing high, but I believe that with volumes coming back and with the price action stabilizing at the 1190-80 mark, I believe a solid base over the near term has been established. So would suggest a buy on Piramal Enterprise, expecting the stock to move towards levels of at least 1300 to 1350.
Okay, so that's the take coming in as far as Piramal Enterprises is concerned. If I have it right, the company did participate in a couple of roadshows last week, and overall the interest was quite high from the long-only investors and hedge funds, and the takeaways have been positive. At least that's the word coming in from one of their brokerages as well.
If you like this video, then like, share and subscribe to ET Now.